coming week, there are two big sets of macroeconomic data to focus on, one from at home, one from overseas. On the domestic front, we've got the latest inflation and wage growth numbers on Tuesday the 16th and Wednesday the 17th of October respectively. Now, wage growth had finally just nosed ahead of inflation, giving hard-pressed consumers and possibly retailers something to smile about. But with oil prices rising and the pound failing to make any further ground, at least against the dollar, inflation picked up again last month and ran slightly ahead of total wage increases, including bonuses. Just to remind you about the headline figures to watch, on the inflation front, prices rose by 2.7% year on year, according to the Consumer Price Index or CPI, and 3.5% on the Retail Price Index or RPI. Meanwhile, wage growth, including bonuses, was just 2.6% year on year, as unemployment came in unchanged at 4%, its lowest mark since 1975. This chart here compares wage growth with the Consumer Price Index reading, or CPI. Now, overseas, the big numbers are due from China. This is particularly timely. The country's Shanghai Composite Index is swooning again, even as the authorities cut interest rates and banks' capital requirements to try and encourage them to lend. In fact, many investors are looking to China for fresh fiscal and monetary stimulus to give its economy a lift in the face of the tariff onslaught from President Trump. Such action dragged global stocks out of a funk in early 2016, and it may be why some analysts are expecting China to attempt a similar rescue, not least because the Shanghai Composite is now trading in bear market territory, down by more than 20% from its January high for the year. In fact, even worse, the Chinese stock market benchmark is back where it was in early 2007, before the great financial crisis, let alone the bubbly bull run of 2014 to 15. We've got two important data sets coming up from China, both on the 16th. First, third quarter GDP growth. Don't expect any surprises here. The authorities are targeting growth of 6 to 7% for the year, so I suspect that's what we're going to get. In the second quarter, the growth rate was 6.7%, and this chart shows quarterly figures for the last 5 years. Secondly, we've got year-on-year growth data for tangible fixed asset investment, retail sales and industrial production. And as we can see from this 5-year chart, all three have been slowing quite markedly this year. Last month, for the record, fixed asset investment rose 5.3% year on year, retail sales grew 9%, and industrial production 6.5%. Now, no doubt economists and stock market bulls will be looking, or at least hoping, for an improvement on all three fronts. So let's see what happens. Now, turning to companies, the pace of events is about to pick up too. 7 FTSE 100 firms have scheduled statements or events in the week ahead, alongside a good selection of small and mid-cap names. And they include fund management giant Schroders on Monday the 15th, house builder Bellway and theme park operator Merlin on the 16th, another house builder, Barratt Developments, as well as BHP Billiton, real estate investment trust Segro, media giant WPP and online fast fashion phenomenon ASOS on Wednesday the 17th, Ratcatcher Rentokil on the 18th, and finally, London Stock Exchange Group and estate agency industry disruptor Purplebricks on Friday the 19th of October. However, the company that looks most likely to cause a fuss in the week ahead is Unilever, when it unveils a third quarter trading update on Thursday the 18th of October. This is the first chance for the Anglo-Dutch food, personal care and hygiene giant, which owns Knorr, Ben & Jerry's, Marmite, Magnum, Persil, Dove, Domestos and many others. It's its first chance to pick up the pieces in the wake of the shareholder rebellion in the UK against its plans, now dropped, to shift its headquarters and primary stock market listing from the UK to the Netherlands. Now, despite the completion of a €6 billion share buyback programme and a fairly confident set of first half results back in July, the shares have weakened of late and are now barely unchanged for 2018. After the embarrassing reverse on the HQ move, Chief Exec Paul Polman will no doubt be looking to show that the company is on track to deliver on its medium-term financial goals, namely 3 to 5% organic sales growth a year and an operating margin of 20% by 2020. As such, the key numbers to watch in the trading statement are as follows. First, it's the underlying sales growth number. Remember, the headline figure will drop owing to the disposal of the spreads business. Analysts will be measuring this against the 3 to 5% organic target, especially as the growth rate dipped below that to 2.2% year on year in the second quarter. We can see the quarterly progression over the last 5 years here, and Unilever has been finding it hard to meet Mr. Polman's target for a good year or so now. Secondly, then you need to home in on the mix between prices and volumes when assessing the quality of the sales growth. Unilever's focused on volume rather than price of late, which may hark back to the dispute with Tesco over the price of Marmite back in 2016. Now finally, Unilever doesn't tend to comment on profits at the third quarter stage. Just in case it does, however, the consensus for headline operating profit is €9.2 billion, with an underlying number of €9.4 billion, once you adjust for some restructuring costs. These figures compare to €8.9 and €9.4 billion a year ago, though they included spreads. But more importantly, the underlying operating margin expected by analysts for this full year is 17.8%. Now that's tantalisingly near to Mr. Polman's 20% target, but is intriguingly a touch lower than analysts have been looking for over the summer. Thank you for watching, and I look forward to seeing you next time.